You've probably heard recently that many of the world's largest companies have been falling over the last month, so you might think that a lot of people are losing money. But what would you say if I told you that many people are also profiting from this? You'd probably say, but how is that possible if everything is in the red and everyone is losing money? Well, it turns out there's a way to profit from market drops, like the ones we've seen in recent weeks. This method has a specific name, and it's called a CFD. And in this video, I'm going to explain everything in depth. Let's start with the basics. CFD stands for Contract for Difference, which in Spanish would be Contrato por Diferencia. And the name tells you everything, because it's literally a contract between you and a third party, which in this case is a broker, an investment platform, where both agree to exchange the price difference of an asset between the moment you open the trade and the moment you close it. In other words, you don't buy the asset itself. You don't own that stock, that gold, that oil, that company, or anything at all. What you do is trade based on its price movement. And don't worry, I know this might sound very technical or difficult, but on this channel, we're not here to talk like that. We're here so that everyone can understand it perfectly, whether they know a lot or a little about these kinds of topics. So I'm going to give you a very simple example so you can understand it right away. Imagine you see a house in your neighborhood, and you think that house is going to go up in price in the coming months or years. In the world of traditional investments, what you'd have to do is buy that house, wait for it to go up in price, meaning your theory is proven, and then sell it later on. But with a CFD, what you're doing is something like making an informed bet. You say, I think that house is going to go up in price, and you make an agreement with someone, who in this case would be the seller, but in the case of a CFD trade, it would be the broker. If the house actually goes up, that person pays you the difference. If the house goes down, you pay the difference to that person. And you'll ask, what difference? What's that mean? Don't worry, I'll explain later. The point is, you never actually bought the house or had the deeds. You just traded on the price. That's how a CFD works. Now, pay attention to something very important. When we talk about regular stocks, ETFs, or investment funds, you buy the asset and you own it. If you bought a share of Amazon, that share belongs to you. But with a CFD, that doesn't happen. You don't own anything. You're simply speculating on the price of that asset. And this has its advantages, but it also has its risks, which we'll look at later on. But first, let's see how this works in practice, because that's where it gets interesting. You already know what a CFD is in theory, but now let's bring it down to earth with real numbers so you can see exactly how money is made and lost with this. Suppose you're looking at the price of gold, and right now, just to pick a price, it's at $2,300 an ounce. You analyze the market, check the news, look at the charts, and you conclude that gold is going to go up. So what you do is open a buy CFD, which in the trading world is called going long, or in English, going long. You open that trade at 2,300, and it turns out that gold actually rises to 2,350. You decide to close the trade at that point. Now I ask you, and pause this video right now, how much did you make the moment you closed that trade? The answer is the difference. Now you tell me how much that difference is to see if you're actually getting it. Well, the difference is $50 for every unit you've traded. Meaning, if you traded one contract, you made $50. If you traded 10 contracts, you made $500. It's that simple. What you actually earned was that difference between what you invested then, which was $2,300, and what you sold for or closed the position at, which was $2,350. But now comes the interesting part, and it's something you can't do with traditional investments so easily. What happens if you think the price of gold is going to go down? Well, with a CFD, you can also make money in that situation. This is called going short, and by the way, I recommend you watch a movie that has that exact name. It's called Short, and I think you can find it on Netflix. It explains this very well. For anyone who wants to dive deeper, it's really interesting. I think it's actually called The Big Short. You can look it up. Now, in this case, to go short, you can open a sell position at 2,300, but gold drops to 2,250 and you close the trade. This time, you also won because you went short, meaning you made $50 per unit. So with the CFD, you can win whether the price goes up or down as long as you get the direction right. And if you don't get it right, well, you lose. There's a key concept here that you need to understand before moving on, and that's leverage. Leverage is basically the broker lending you money so you can trade with more capital than you actually have. Let me explain it with specific numbers. Let's say you have $100 in your account. Without leverage, you could trade with those $100, but if the broker offers you 1-to-100 leverage, that means with $100, you can open trades worth up to $10,000. That sounds great, and it is, but watch out, because this is a double-edged sword. If the market moves in your favor, your profits obviously multiply. But if the market moves against you, your losses also multiply. And this is where many people lose money with CFDs because they over leverage without understanding the risk. Now, also, the last concept you need to understand is the spread. The spread is the difference between the buy price and the sell price of an asset at the same time. That's basically the broker's commission. For example, if gold is at $2,300 to buy, but at $22.99 and 50 cents to sell, that 50-cent difference is the spread. So when you open a trade, you technically start with a small loss equal to that spread, and you need the market to move enough in your favor to cover that cost and start making a profit. The lower the spread, the better for you as an investor. But anyway, let's say you already understand what they are, how they work, what leverage is, what the spread is, which are the basic concepts of CFDs. Now, the million-dollar question is, where do I do this? Where can I invest in CFDs? And here's something very important I want you to keep in mind, and that's that not just any platform works for this. When you're going to choose that person, which in this case would be a broker, well, you have to keep several things in mind. First, regulation. This is the most important thing of all. A regulated broker means there's a financial entity or an official body that supervises it, that requires it to comply with rules that protects clients. Without regulation, it's like getting on a plane where the pilot doesn't have a license. You might arrive safely, but why take the risk? Second, the costs. Look at their spreads, commissions, and any fees for keeping a trade open overnight, called swaps. But in this video, we won't go into all of those specific details too deeply. In a second video we can, based on how this one does. And third, accessibility, that you can deposit and withdraw from your country without complications, that the platform is easy to use, that it has support in Spanish or the language you speak or prefer. This might seem like a minor detail, but when you have a problem with your money and can't find anyone to help you in your language, that's not minor at all, obviously. And well, a platform that meets these characteristics and that personally seems interesting to me for those starting out in the world of CFDs is Pepperstone. This is a broker that was founded in 2010 in Melbourne, Australia, and is currently regulated by several financial entities globally. It's regulated by the FCA in the UK, by ASIC in Australia, by CYSEC in Cyprus, by BaFin in Germany, and for those in Latin America, it operates under the SCB in the Bahamas. So what can we trade? We're talking about CFDs, where the CFD is the contract, but the underlying asset varies. We mentioned gold, but there are also specific stocks and other assets. In this case, for this platform, it has more than 1,200 instruments that you can invest in through CFDs. We're talking about currency pairs, forex, stock indices like the S&P 500 or the NASDAQ, commodities like gold and oil, stocks like Tesla, Apple, Nvidia, and also cryptocurrencies like Bitcoin and Ethereum, all through CFDs. Plus, there's no minimum deposit. So technically, you can start with whatever amount you want, although obviously it's recommended that you start with an amount with which you can manage your risk well. And for those who are starting out, which is probably your case if you're watching this video, they have a demo account, which is what really catches my attention the most and what I'd say a person who wants to start learning or testing should do. And with that demo account, you have 50,000 virtual dollars to practice without risking a single cent from your pocket. I find this super valuable because it allows you to understand how the platform works, test strategies, and familiarize yourself with everything before putting in real money. In the video description, I'll leave a link in case you want to take a look. And as for trading platforms, for those who are a bit more aware of this world, Pepperstone gives you access to MetaTrader 4, MetaTrader 5, CTrader, and TradingView, which are practically the most used platforms in the trading world. By the way, if you're not going to start investing yet, or are just going to start with a little, they have an option where they give you TradingView for free for a certain amount of time. I'll leave that in the description too for anyone interested. So you've understood how CFDs work, what they are, where to invest, and the types available. But now we must discuss how I don't like to sell the idea of becoming an overnight millionaire. Actually, I like to be realistic. So let's talk with total honesty about the pros and cons of CFDs, because it's not all sunshine and rainbows, and I think it's important you have the full picture before making any decision. Let's start with the advantages. The first is that you have access to global markets from a single platform, from your computer or your phone, anywhere in the world. In any city in the world, you can trade assets from the United States, Europe, Asia, with commodities, with cryptocurrencies, all from one place. Secondly, you can trade both ways. As mentioned, you can profit if the price goes up or if it falls. In traditional investments, when the market drops, you must wait for recovery. With CFDs, you can profit from those downward movements. The third advantage is that the initial capital can be low. Thanks to leverage, you don't need to have thousands and thousands of dollars to be able to invest. With a relatively small amount, you can access larger investments. And the fourth advantage is flexibility. You can open and close trades in minutes and hours or keep them open for days. You decide according to your strategy. Now, the risks. And this is where I need you to pay close attention because it's what will determine if you do well or poorly with CFDs. Risk number one is leverage. Yes, the same one I mentioned as an advantage is also the greatest risk. If you don't know how to handle leverage, you can lose much more money than you intended. In fact, statistics say that approximately 80% of retail investor accounts, that is, like you or me, lose money when trading CFDs. Yes, you read that right, 80%, and that's a reality. And this isn't because CFDs are a scam or anything like that, but because many people jump in without the necessary education, without risk management, and leveraging themselves like there's no tomorrow. Risk number two is volatility. Markets move constantly and sometimes very abruptly. A news item, an economic data point, a tweet from some important person in the world, especially in the United States, and the market can move in a matter of seconds in a direction you didn't expect. And if you're leveraged, that volatility can affect you a lot. And risk number three is the emotional one. Trading with CFDs can generate a lot of stress, a lot of anxiety, and can lead you to make impulsive decisions. Many people who invest lose money not because of a lack of technical knowledge, but because they don't control their emotions. They see they're losing, and instead of closing the trade, they leave it open, hoping the market turns back. Or they see they're winning and get greedy and want to win more until the market turns around and they end up, instead of winning, losing. So I want to be very clear about this. CFDs are not for everyone. They're a financial instrument that can be very useful if used with knowledge, discipline, and risk management. But if you jump in without preparing, the odds of you losing money are quite high. And I'm not telling you this to scare you, but so you can make an informed decision and not like many, sell it to you like, this is the best, get in now, invest everything you have. No. Before finishing, I want to tell you a few things here between you and me, here in private. Apply this to life, to any investment, to everything. My advice is educate yourself before investing a dime. I don't mean watching a few YouTube videos and becoming a pro. I mean really understanding how this works, technical and fundamental analysis and risk management. Take your time because the market isn't going anywhere, so there's no rush. The second tip is to start with a demo account. Don't put in real money until you feel truly comfortable trading. Practice, make mistakes, and learn, but with virtual money. It applies to this and to life. Practice whenever you can so you don't have to make mistakes directly with your property or your things. You can try something like this. Try it. You lose nothing. It works well because you learn things helpful not just with CFD investing, but with the stock market or nearly any investment. There are concepts that are very similar. So even if you don't get into CFD specifically in the future, still try it. Practice. Just use the demo account. If you like it, jump in. If not, move on. But you've learned something and it helped. Because a thought I have often is that theory is all well and good. Talking from theory is great, but when you get to practice, things change a lot. I don't know if it happened to you. For example, in school or college, you had a math teacher explaining an example on the board, and they'd say, look, it's like this, it's like that. You think, wow, I understand everything perfectly. But then they give you exercises and life is totally different. The solution is different and you're lost. So that's why in daily life, it applies the same way. You could watch 20 videos or read 20 books about this, but in practice, if you risk your own money, you're risking too much. With a demo account, though, you're not. But you might put it into practice and it's all completely different. But that doesn't mean it's bad. It means that in real life, you can start testing and learning how things really are. Because while theory helps as a base, practice is what will set everything up and make it all run like clockwork. The third thing is never to invest money that you can't afford to lose. This applies to any type of investment, but especially for CFDs. If you're thinking about putting in rent money, utility money, or food money, please don't do it. The money you allocate to this should be money that if you lose it, your life goes on as normal. And precisely, many tell me, what do you mean I have to invest money I want to lose, that I'm willing to lose? And it's not about that. It's more about the fact that if you lose it, it doesn't greatly affect your life. So if you lose it, you won't end up living on the street, unable to pay rent or your mortgage. Nobody wants to lose money, but the idea is that losing it won't ruin your life. That's why it's said to be willing to lose. Well, I hope this video helped you clearly understand what CFDs are, how they work, and what their advantages and risks are. Remember that all the links I mentioned in this video are in the description if you want to check them out directly, and also in the first pinned comment. And if you like this video and made it this far, and you want us to dive deeper into more topics like these, or any related topic, let me know in the comments. And those who made it this far, leave an up arrow emoji in the comments so I know who made it to the end. If this video does well, we can keep talking about these topics. Honestly, I've wanted to bring these topics to the channel for a long time, but I feel they often don't get much support. So tell me in the comments if you want us to talk about